Hi and welcome to Swissquote's Daily Market Talk. It's US Jobs Friday and 5th of September. Most data relative to the US jobs confirm the weakening jobs market in the United States, requiring rate cuts from the Federal Reserve. So the latter pulls the short-term yields in the US lower, while the impact on longer maturity bond yields remains quite questionable due to potential inflationary pressures. Elsewhere, the euro-dollar tested the 50-day moving average this morning ahead of Monday's French confidence vote in France that could lead to a government collapse, and crude oil pushes lower on expectation that OPEC will increase its supply quotas for October when it meets this weekend. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So sentiment among US equity investors somehow improved yesterday after the ADP report for August came in weak and even weaker than expected by analysts, showing only 54,000 new private job additions versus around 73,000 expected by analysts, while initial jobless claims in the United States printed a higher than expected figure as well. Separately, the ISM non-manufacturing data hinted at faster than expected expansion in services with slower than expected price pressures, but there also we saw a weakening employment component as well. So if we put the pieces of the US labor data together, the numbers that we saw this week overall clearly pointed at this weakening jobs market in the United States. And that, for those who are not familiar with the way that the financial markets react to data, well, is actually boosting appetite across the risk assets for fueling the dovish Fed expectations and the bets of lower rates in the United States to remedy to this bleeding US jobs market. As such, the US 2-year yield sank below the 3.60% level for the first time since April's trade chaos. The S&P 500 rebounded 0.83% yesterday and closed just a few points from an all-time high level that was reached last week, while the small cap index printed a 1.26% jump during the session. The US dollar index remained steady in between its 50 and 100-day moving averages, and the weaker than expected ADP figure yesterday also pressured the long end of the US yield curve down, sending the US 30-year down to 4.84% this morning after having tested the 5% level earlier this week. So today, a set of softer than expected jobs numbers from the US could further weigh on the US 2-year yield, and we could see the long end of the yield curve take a further breather as well after weeks of selling pressure. As such, all eyes are on the all-important US official jobs data this Friday, and of course, also the revisions to prior months' figures. Remember, last month's big revisions have already switched the Fed's narrative from a quite healthy and resilient jobs market to weakening labor market in the US that could require a policy response from the Fed. So the latter brought forward the possibility of a September rate cut on the table, remember, from no cut expected from the Fed September meeting prior to last month's jobs figures. So today, investors around the world actually do expect to have a final confirmation before the September's Fed decision that the weakening trend in the US jobs market is well in place. It is well anchored and requires a Fed cut or maybe two. But there is no guarantee whatsoever that the dovish Fed expectations will slow the sell-off in long maturity bonds in the medium run, as lower Fed rates today means higher inflationary pressures tomorrow, and longer maturity yields should take that into account. So the story doesn't end here. It doesn't end this week. Next week's inflation data from the US will bring some more pieces to complete the macro puzzle. If data shows that the tariff-led upside pressures and input prices start showing in US consumer price data, then the long maturity papers in the United States could face a renewed selling pressure, as it would mean that the Federal Reserve's policy will be inflationary. So the million-dollar question is, how much potential is left for the US 30-year yield above that 5% psychological mark when you consider that the 20-year break-even inflation rate for the United States is still sitting near the 2.5% level? Well, investors will answer that question. After all, inflation and the Federal Reserve rates and policies are just a part of this equation. But looking beyond inflation and rates, ballooning US debt, rising interest payments due to higher interest rates, and waning foreign appetite for US sovereign debt could bring investors around the world to ask more than 5% return for holding the US 30-year papers. Voila, it's all said now. We now wait for the US jobs data. Elsewhere, the relief on the long end of the US yield curve echoed across global peers as well. A benchmark for European 10-year yield is supporting a rebound in the Stoxx 600 index. Even the problematic French 10-year bond yield came down yesterday and the French-German 10-year spread narrowed. But there is no major progress in France's political situation, mind you, and there is a very, very good chance that Beirut's government will collapse by next Monday, pushing the country into a renewed period of political deadlock, with obviously budget risks still looming. And therefore, we could eventually see this Friday some investors taking risk off the table into the weekend and going into, well, next Monday's confidence vote flat. So if that's the case, we could eventually see gains in the euro-dollar limited as well. Yet the euro-dollar's overall direction will probably likely be more determined, more influenced by where the US dollar will be headed after the jobs data. A set of weak data would revive purchases in the euro-dollar, while a set of stronger than expected US jobs data could lead to a US dollar recovery and keep the euro-dollar below its 50-day moving average into the weekly closing bell. In Asia, the Japanese 20 and 30-year yields also see some relief this morning, but the Nikkei index has been unable to extend its early session gains that were actually backed by the bond relief that we see across the globe and the news that the US auto tariffs would be cut to 15% from 27.5% previously. So Toyota actually gained, but it gave back most of its gains after testing the 3,000 mark to the upside this morning. So the rapid loss of appetite that we see in Japanese stocks was certainly also due to data showing that the nominal wage growth in Japan rose 4.1%. So that's the highest level in 7 months, fueling the Bank of Japan hawks and the expectations of a rate hike in Japan sooner rather than later. So the USD JPY remained offered into its 200-day moving average this morning and even this week, but conviction among the yen bulls remains quite weak to predict a reversal of the post-April bullish trend. In China, the CSI 300 index is better a bit this morning, but the fact that the government is now taking measures to avoid a market bubble reminds investors that the Chinese government is never too far, and that's not really encouraging, unfortunately. In the commodities space, gold consolidates gains near its all-time high level, while the US crude couldn't hold on to its own gains above the $65 per barrel psychological and technical level this week on prospects that OPEC will increase supply quotas for October at Sunday's meeting, giving the oil bears, a strong reason to sell when bullish sentiment in the oil markets was building, but building just timidly. But the geopolitical risks prevail as there is now a mounting risk of further Russian attacks on Ukraine, according to the latest reports, which will further wane whatever was left of past week's hope for peace in Ukraine. So at this point in time, it looks like peace in the foreseeable future in Ukraine is unfortunately nothing more than wishful thinking. So for oil, that means that the downside potential could remain limited into the $60 to $62 per barrel range, even with extra OPEC supply in the market. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.